What's going on, guys? You already know what's going on. It's another educational video. As always, my name is Reon Hunt. I'm going to be coming at you talking to you about index universal life policies today. Stay tuned. What's up, guys? Man, we're on a roll, guys. 3 days of doing straight videos, straight recording, but I love it. It's education. We're helping educate everyone. People need to know these things. So, what we're talking about today is an index universal life policy, like I said. So, we already talked about term policies, we talked about permanent policies, and in that permanent policies video, we talked about something called an index universal life policy. And what we're going to do today is touch on it a little further and go more in depth. So an IUL policy, just like we talked about in the permanent policies video, which if you haven't seen it, I recommend you go back and watch it because it'll allow you to understand what we're going to talk about today a little more. But just like in the video, we talked about this policy is permanent. Just like it sounds, it doesn't end so long as you pay your premiums. But the good thing about this, and the couple of things that are good about this type of policy over a term policy, one main reason is the flexible premiums. So with flexible premiums, that pretty much means I am the insurance company and I'm saying this is your premium that you pay a month. But in this policy, you can pay down to the minimum premium as well. If times are tough and you really don't have a lot of money in the household, we'll drop your premium down to this amount and you can pay this and your coverage will still continue. But for your coverage to continue without lapsing, you need to continue to pay the stated premium that we have. But also, if you have extra money and you want to put it into your policy, you can pay more than the premium, and that'll only help you build your cash value faster. So that's one of the main differences over a term policy versus an IUL. Because with a term policy, you can't pay lower than your stated premium. If you pay lower, they're not going to accept it. And if you don't pay it at all, your policy is going to lapse and you have no more coverage. Another great thing that people don't know about IUL policies is that the cash value, yes, we usually know that it's invested into the S&P 500, which is the market, okay? But one thing that we really don't know usually is that in this account, the insurance company guarantees that you lose no money in the cash value. No money in your cash value will be lost. So you can pay and put money after money after money and continue to stack it, okay, with compound interest, but they will guarantee that you lose no money out of the cash value. Where can you get that guarantee anywhere else in the market? You can't get that guarantee in a stock. You can't get that guarantee in a mutual fund. You can't get that guarantee in an IRA, a 401k. But in this IUL, you're guaranteed to lose no money on the money that's in the cash value. But here's the difference. The money that's in the cash value, yes, you're guaranteed to lose no money, but you are capped on your upside. So how it works is you have guaranteed downside protection, but you have limited upside. So if the market goes up 40%, you might be capped at 10. But if the market goes down 40%, like 2008, then you lose nothing. So it's really what you feel like is best for you. If you're okay with losing money, great. You can put it in a stock and try your luck. But if you want to be protected and know how much you're going to have for retirement, then an IUL might be a good option for you. Another thing that people usually don't know is that in IUL policy, you can actually take distributions out of it once you get to a certain age or whenever you feel like you want to retire. You can pull distributions out similar to a 401k, but you can set it up to where you can never outlive your money. So you can set it up to where the insurance company will guarantee you that they will give you $3 grand a month for the rest of your life, 4 grand, 5 grand, 10 grand, however much you build the cash value up to. But the insurance company can guarantee that you have this set amount of money per month for the rest of your life. No matter if you use all the money in the policy, you're in a contract. So the insurance company will guarantee that this money will be given to you for the rest of your life, no matter what. You cannot outlive it. Again, one of the biggest differences between this policy and term policies is that these policies are going to be more expensive than your typical term policies. Why? Well, we just talked about all the reasons why. You have cash value in this policy and it's permanent. So it's going to be more expensive than a policy that ends 10, 20, 30 years later. Guys, even if you knew all about IULs before watching this, or if you knew nothing about IULs before watching this, I really hope that I provided you with some value in this video. And you guys take care. You guys have a blessed one. I'll see you in the next episode.